Donald Trump stepped onto the south lawn of the White House on a Friday afternoon, expecting another easy headline. Marine One was already spinning behind him. Reporters crowded forward, cameras locked in. And standing just feet away from the helicopter, Trump decided to turn Canada into the punchline. He laughed at the Canadian economy, called the Canadian dollar monopoly money with snow on it, said Canada survives on American patience. Then he mocked Mark Carney personally, describing him as a clerk in a sweater. People behind Trump laughed. The cameras caught it. The clip exploded online within minutes. And at first, it looked like just another viral political moment, another Trump soundbite, another media cycle, another insult between Washington and Ottawa. But then something happened that almost nobody inside the White House expected. Canada said nothing. No angry statement, no emergency press conference, no retaliatory threat, no diplomatic outrage. Nothing. And over the next 72 hours, that silence triggered one of the strangest economic reactions North America had seen in years. Because while Trump's supporters celebrated the clip online, financial markets started getting nervous, very nervous. Wall Street analysts suddenly began asking questions that had absolutely nothing to do with political theater. Why were central banks quietly shifting reserve exposure away from the U.S. dollar? Why were commodity traders suddenly increasing Canadian dollar positions? Why were energy companies contacting federal officials over bilateral risk exposure? Why were bond markets reacting as if something structural had changed underneath the U.S. Canada relationship? And why did the silence from Ottawa feel more dangerous than an actual response? By Monday morning, according to estimates from multiple financial institutions, the United States had already lost tens of billions of dollars in market value, trade exposure, and currency positioning. All triggered by 47 seconds on the South Lawn. That is the story unfolding right now. And underneath the headlines, it may reveal something much bigger than one political insult. Because this is not just about Trump, and it is not just about Canada. This is about what happens when the world's largest economy starts discovering that its allies no longer react to pressure the way they used to. For decades, Washington operated with one enormous strategic advantage. Most countries could not afford prolonged conflict with the United States. Economically, financially, diplomatically. The American market was too large. The dollar was too dominant. The trade relationships were too important. And because of that, American pressure usually produced one of two outcomes: submission or escalation. But what happened over these 72 hours was completely different. Canada did neither. And that may be exactly why the markets reacted so violently. Because silence only works as a strategy when the country choosing silence has already built alternatives underneath it. That is the part most people still do not fully understand. Over the past 2 years, Canada has quietly been restructuring major parts of its economic positioning globally. Trade diversification, energy corridors, currency settlement mechanisms, supply chain partnerships, Asian export relationships, European coordination, critical mineral strategy, defense manufacturing integration, and perhaps most importantly, reduced vulnerability. That process accelerated dramatically after repeated trade confrontations between Washington and Ottawa, especially around tariffs, industrial policy, energy disputes, and supply chain security. At first, many people inside the United States treated Canada's response as symbolic politics. But inside financial institutions and commodity markets, a different conversation had already started. Because Canada is not just another neighboring economy, Canada sits directly inside the operational architecture of the American economy itself. American auto manufacturing depends heavily on Canadian supply chains. U.S. energy infrastructure depends heavily on Canadian crude. Agricultural systems depend heavily on Canadian fertilizer exports. Electric grids across parts of the northern United States rely on Canadian hydroelectric integration. And beneath all of that sits something even more important: trust. The entire North American economic system was built on the assumption that the United States and Canada functioned as stable strategic partners. That assumption matters enormously in financial markets, because markets do not only price economics, they price predictability. And suddenly, after Trump's remarks, predictability started breaking down. That is why traders reacted so quickly, not because they cared about political drama itself, but because the silence coming from Ottawa signaled something much more unsettling: confidence. Cold confidence. The kind of confidence countries display when they believe they no longer need immediate reconciliation. That is a very dangerous signal in geopolitics, especially for the larger power in the relationship. And according to multiple reports emerging afterward, Canadian officials understood that immediately. Inside Ottawa, the decision not to respond was apparently made very quickly, because the Carney government reached a strategic conclusion over the weekend. Responding emotionally would help Washington. Silence would force the markets to interpret the situation themselves. That distinction changed everything. Because if Canada had responded angrily, the story would have become political theater. Another trade fight, another diplomatic clash, another negotiation cycle. But silence transformed the story into uncertainty. And uncertainty spreads extremely fast through global markets, especially currency markets, especially bond markets, especially commodity markets. By early Monday morning, signs of stress were already appearing internationally. Several central banks quietly disclosed adjustments in reserve positioning away from heavier U.S. dollar exposure. Currency traders started moving toward alternative positions. Analysts began openly discussing whether America's political volatility itself was becoming a long-term economic risk factor. That conversation matters enormously because global reserve systems operate heavily on trust and stability, not just military power, not just GDP size. Confidence. That confidence underpins the dollar system itself. And for years, the United States benefited massively from being viewed as the most stable center inside the global financial order. But over the past decade, something has slowly started changing. Countries everywhere began reassessing dependence. On supply chains, on energy routes, on manufacturing hubs, and increasingly, on the dollar system itself. Not because the dollar is collapsing. It isn't. But because geopolitical fragmentation has made countries more cautious about concentration risk. That trend accelerated after sanctions battles, trade wars, tariff escalations, Russia-related reserve seizures, semiconductor restrictions, banking instability, pandemic supply disruptions. Now governments across the world increasingly prioritize flexibility, not just efficiency, and Canada appears to understand that shift extremely well. That is why Ottawa's silence felt so powerful, because it signaled that Canada may believe it now possesses more room to maneuver than Washington previously assumed. That changes the psychology of the entire relationship, and the markets noticed immediately. By the time Wall Street opened Monday morning, the conversation was no longer, "Did Trump insult Canada?" The conversation had become, "Why does Canada suddenly look so comfortable absorbing the insult?" That is a completely different question, and it led directly into the next phase of the crisis. Because while political media focused on the viral clip from the South Lawn, financial institutions started calculating the exposure underneath the relationship itself, exposure most Americans rarely think about: integrated manufacturing, cross-border energy dependency, commodity settlement systems, currency reserves, trade routing, industrial logistics, supply chain synchronization. Suddenly, analysts began modeling scenarios that until recently sounded almost unthinkable. What happens if America's closest ally gradually starts diversifying away from automatic economic dependence? What happens if political volatility inside Washington starts carrying measurable financial risk premiums? And perhaps most importantly, what happens when America discovers that silence from an ally can move markets more powerfully than public confrontation? That was the realization spreading quietly through Wall Street by Monday morning. And then Mark Carney finally walked to the podium. By the time Mark Carney stepped in front of the cameras Monday morning, the atmosphere surrounding the story had completely changed. This was no longer just another political controversy. Now it was a market event. Currency traders were watching. Bond desks were watching. Central banks were watching. Energy markets were watching. And perhaps most importantly, Washington was watching. Because over the previous 72 hours, the silence from Ottawa had created something extremely dangerous for the White House, a vacuum. And in geopolitics, vacuums rarely stay empty for long. Markets fill them. Allies fill them. Speculation fills them. Fear fills them. That is exactly what happened here. Trump's remarks on the South Lawn lasted less than a minute, but Canada's silence lasted 3 full days, and the longer the silence continued, the more powerful it became psychologically. Why? Because silence changes the burden of interpretation. When two countries openly fight, both sides control part of the narrative. But when one side refuses to engage entirely, the other side suddenly owns all the consequences alone. That is what financial markets started pricing by early Monday. Not Canadian outrage, American instability. That distinction is critical, and Carney understood it perfectly. When he walked to the podium in Ottawa, reporters expected retaliation, a threat, a counterattack, some kind of escalation. Instead, Carney spoke calmly, almost coldly. He did not mention Trump directly. He did not repeat the insults. He did not raise his voice. And that restraint made the moment even more powerful, because restraint signals confidence, especially in negotiations. Especially between countries, especially when the larger power expects emotional reaction. Carney began by referencing the quiet reserve disclosures released earlier that morning by several major central banks. That detail mattered enormously, because those disclosures revealed something the public barely noticed at first. Multiple foreign reserve institutions had quietly reduced portions of their U.S. dollar exposure, while increasing positions connected to alternative reserve holdings, including the Canadian dollar. Not massive shifts, not dollar collapse, but enough to send a message markets immediately understood. Global institutions were beginning to hedge political risk differently, and that trend directly threatened one of America's greatest strategic advantages, the assumption of permanent financial centrality. Again, this does not mean the dollar is disappearing. Far from it. But reserve systems evolve slowly. And once countries begin diversifying even slightly, the long-term implications become extremely important. Because reserve diversification changes borrowing dynamics, treasury demand, capital flows, energy settlement behavior, sovereign leverage, geopolitical bargaining power. That is why the reaction to Carney's speech spread so quickly through financial media. The speech itself was short, but the symbolism behind it was enormous. Then came the line that changed the entire story. Dignity is the asset they cannot tax. 9 words. That was it. No shouting, no outrage, no threats. Just 9 words delivered calmly from a podium in Ottawa. And within minutes, the phrase was everywhere. Bloomberg terminals, trading chats, financial television, political panels, currency analysis desks. The phrase spread because it captured something much larger than the immediate dispute. It captured the feeling that America's allies were beginning to rethink how they respond to pressure itself. That is the deeper geopolitical shift underneath this story. For decades, the United States operated inside a world where economic pressure usually forced alignment. Countries depended heavily on American markets, dollar systems, U.S. financial infrastructure, American security guarantees, U.S.-controlled trade access. But over time, the global system became more distributed. China expanded, alternative payment systems emerged, regional trade blocs strengthened, energy routes diversified, supply chains decentralized, and middle powers started discovering they possessed more leverage than they once believed. Canada is one of those middle powers, especially because Canada's importance inside the North American system is much larger than many Americans realize. This is not a small peripheral economy. Canada supplies enormous portions of U.S. crude imports, electricity integration, fertilizer exports, critical minerals, automotive components, aluminum, lumber, uranium, rare resource chains. And because these systems evolved together over decades, replacing them quickly becomes extraordinarily difficult. That creates interdependence, real interdependence, not symbolic diplomacy, structural interdependence. And that is exactly why the silence from Ottawa created such anxiety on Wall Street, because markets suddenly started realizing something uncomfortable. The United States may need stable relations with Canada more urgently than political messaging in Washington previously assumed. That realization carries consequences far beyond this specific incident. Because once markets begin pricing political volatility into allied relationships, the effects spread everywhere. Manufacturing investment decisions change, infrastructure planning changes, currency hedging changes, cross-border expansion changes, corporate risk modeling changes. That process can become self-reinforcing, and signs of that process were already appearing by Monday afternoon. The dollar weakened sharply against several major currencies. Treasury yields moved higher, equity markets fell. Commodity traders adjusted positioning, cross-border industrial firms started reviewing contingency planning. Not because America was collapsing, but because investors hate uncertainty, especially uncertainty involving foundational economic relationships. And what terrified markets most was not the insult itself. It was the possibility that the relationship underneath the insult had fundamentally changed. That possibility became even more serious when business leaders started speaking publicly. Major manufacturing executives warned about rising bilateral risk. Energy firms raised concerns over long-term supply assumptions. Agricultural groups quietly contacted lawmakers. Auto industry analysts discussed cross-border vulnerability openly, and underneath all of those reactions sat one core fear. What if North America itself was beginning to fragment economically? That question would have sounded ridiculous 20 years ago, but today, not impossible, because the modern global economy is becoming increasingly fragmented everywhere. Europe is reshaping industrial policy. China is building parallel systems. India is expanding strategic manufacturing. Middle powers are hedging dependencies, and countries everywhere are prioritizing resilience over maximum integration. That is one of the defining geopolitical shifts of this era. The age of hyperglobalization is fading. The age of strategic redundancy is replacing it. And in that environment, political trust becomes economically valuable, very valuable. That is why Carney's restraint mattered so much. He was signaling something carefully to markets, allies, and institutions simultaneously. Canada was not panicking. Canada was not cornered. Canada believed it possessed alternatives. And once a smaller power successfully projects that perception against a larger one, the psychology of the relationship changes immediately, especially financially, because financial systems run heavily on expectations. The expectation that America automatically dominates negotiations. The expectation that allies eventually fall back into alignment. The expectation that Washington always controls escalation. Those assumptions suddenly looked weaker after the 72-hour silence. And then another voice entered the story, one that made Wall Street pay even closer attention. Warren Buffett. Because according to multiple reports circulating afterward, Buffett viewed the entire situation through a much larger historical lens, not as a political fight, but as a power transition signal. And his interpretation of the silence would end up becoming one of the most quoted reactions anywhere in global finance. When Warren Buffett reportedly described the situation to his portfolio managers, he did not focus on tariffs, he did not focus on trade negotiations, and he did not focus on Trump personally. Instead, Buffett focused on something much deeper: power psychology. Because according to multiple accounts, later referenced across financial media, Buffett believed the most important event over those 72 hours was not what Canada said, it was what Canada refused to say. That distinction matters enormously, especially historically. Great powers often assume they control negotiations because they control scale. Larger economies, larger militaries, larger markets, larger financial systems. But history shows that once smaller powers develop credible alternatives, something changes, psychologically. The larger power slowly starts discovering that pressure no longer produces automatic compliance, and that realization can become extremely destabilizing, not only politically, financially, because financial markets are deeply sensitive to shifts in perceived leverage. That is why Buffett reportedly framed the silence itself as the most expensive signal in the entire story. A country that cannot afford silence reacts immediately. A country that can afford silence projects confidence, and confidence shapes markets. That interpretation spread quickly through Wall Street because it aligned with something investors had already been noticing globally. The world economy is becoming less centralized. Not anti-American, but less centralized. That is a very important distinction. The United States still remains the dominant financial power on Earth. The dollar remains the world's reserve currency. American markets remain enormous. But increasingly, countries everywhere are trying to avoid excessive dependence on any single system. That includes allies, especially allies, because recent years fundamentally changed how governments think about vulnerability. The pandemic exposed supply chain fragility. Sanctions battles exposed reserve risk. Tariff wars exposed manufacturing dependence. Energy crises exposed infrastructure vulnerability. And now countries across the world are restructuring economic strategy around one idea: flexibility. That word matters enormously in modern geopolitics. Countries no longer want maximum efficiency at any cost. They want room to maneuver, strategic redundancy, alternative routes, alternative suppliers, alternative settlement systems, alternative alliances. And Canada spent the last 2 years quietly building exactly that. That is why the 72-hour silence worked. Not because silence itself is magical, but because silence backed by alternatives becomes leverage. That is the key lesson underneath this entire story. Because if Canada had remained fully dependent on immediate American goodwill, the silence would have been impossible. Markets would have punished Ottawa immediately. Investors would have panicked. Political pressure would have intensified. Instead, the opposite happened. The pressure flowed back toward Washington. That reversal shocked people, especially inside the United States, because for decades, the assumption underneath North American economics was simple. Canada needed stable relations with America more than America needed stable relations with Canada. But what if that balance has started changing? Not completely, not dramatically overnight, but structurally, slowly, quietly. That possibility is what markets began pricing after Trump's remarks. And once that conversation started, the implications expanded far beyond one weekend controversy. Because if America's closest allies increasingly believe they can absorb public pressure without immediate economic collapse, then Washington's negotiating leverage changes everywhere. Europe notices, Asia notices, currency markets notice, commodity exporters notice, central banks notice, and perhaps most importantly, investors notice. That matters because global finance ultimately runs on perceived stability, and political volatility increasingly carries measurable costs. The 72-hour episode demonstrated that very clearly. Within days, equity markets weakened, treasury yields moved, the dollar fell against major currencies, corporate leaders warned about bilateral risk, manufacturing concerns intensified, supply chain fears resurfaced. Again, this was not economic collapse, but it was something potentially more important: a warning. A warning that geopolitical trust itself now carries direct financial consequences inside the modern economy. That trend is becoming increasingly visible globally. Countries are reassessing alliance reliability, political predictability, trade exposure, reserve concentration, strategic dependence. And that process is accelerating. Not because globalization is ending completely, but because globalization is becoming more fragmented, more regionalized, and more politically conditional. That is the world now emerging underneath the headlines. And in that world, middle powers like Canada suddenly gain more room to maneuver than they possessed during earlier decades, especially when they control energy, resources, industrial supply chains, critical minerals, strategic geography, financial credibility. Canada possesses all of those things. That does not make Canada stronger than the United States, but it does make Canada harder to pressure than many people previously assumed. And that realization may be the most important consequence of the entire episode. Because ultimately, this story was never really about one insult on the South Lawn. It was about the limits of leverage in a changing global system. Trump expected the remarks to dominate the narrative. Instead, the silence afterward became the real story. And perhaps even more importantly, the markets believed the silence. That is what changed everything. Because financial markets are brutally pragmatic. They do not reward emotion. They do not reward pride. They reward confidence backed by systems. And over those 72 hours, investors appeared to conclude that Canada had spent years quietly building systems capable of absorbing exactly this kind of pressure. That realization carried consequences immediately. But the longer-term implications may matter even more. Because once allies start demonstrating they possess credible alternatives, the geopolitical structure of the Western economic system slowly begins evolving. Not collapsing, evolving. Toward more diversification, more regional balancing, more strategic autonomy, more distributed leverage. And that transition changes how power itself functions. The loudest country no longer automatically controls the outcome. The largest economy no longer automatically controls the psychology. Sometimes the country projecting the most confidence is simply the country least desperate to react. That may be the deepest lesson underneath the entire 72-hour silence. A smaller ally discovered that restraint itself could become leverage, and the larger power discovered that in a fragmented global economy, pressure does not always produce submission anymore. Sometimes it produces distance. Sometimes it produces diversification. And sometimes it produces silence powerful enough to move markets across 3 continents. Thank you for watching USA News Now. I'm Daniel Mercer.